If this story were only about gold or silver prices rising, it would not be serious enough to make the entire financial world whisper behind the scenes. Prices can fluctuate for countless reasons, but what is truly worrying institutions right now is not what's on electronic price boards, but a very practical question. If the precious metals derivatives market were required to deliver physical metal on a large scale, would there still be enough metal in the vaults to deliver? This is the point most retail investors have never had to think about. For decades, COMEX and derivatives exchanges have operated smoothly based on an implicit assumption. Most contracts would be settled in cash. The physical gold and silver in vaults only needed to be sufficient for a small percentage of people who actually demanded delivery. That assumption held true for a very long time. And precisely because it held true for so long, when market behavior changes, the system immediately exposes its weakness. Public data show that the volume of gold contracts standing for delivery in the February cycle is extremely high relative to the amount of registered gold, meaning gold that is actually eligible for delivery and sitting in vaults. Each contract represents 100 ounces. Added together, the total potential physical delivery demand reaches tens of millions of ounces. Even in the most optimistic scenario, where a large portion of contracts are settled in cash rather than by taking delivery of gold, the amount of gold that would need to be withdrawn from vaults would still represent an unusually large share of current inventories. By itself, this is not enough to conclude there is a crisis. COMEX has survived many delivery stress episodes in the past. But this time, the context is different. In 2008, the core problem was a shortage of US dollar liquidity. In 2020, a systemic shock caused all assets to be sold off for cash. In both cases, metal was available. The problem was that money was not. Now, the roles appear to be reversing. US dollars are being injected with abundant liquidity, but physical metal is becoming hard to find. This reversal is most clearly reflected in a technical indicator rarely explained by the media: the metal lease rate. Under normal conditions, gold and silver lease rates are close to zero. Metal holders are willing to lend because supply is plentiful, risk is low, and yields are merely symbolic. But when lease rates surge to several percent per year, that no longer reflects a cost of capital. It reflects scarcity. Put simply, those who hold metal no longer want to lend it, and those who need metal for delivery are willing to pay almost any price. This is not a signal of financial speculation. This is a signal from the physical market. Here, the first uncomfortable question appears. If major retail dealers are constantly reporting silver bars out of stock, delivery delays of many weeks, and sharply rising premiums over spot prices, then what makes us believe that banks can find enough silver to deliver against thousands of derivatives contracts? From here, politics enters the story, but not in the way most people are talking about. A government shutdown is usually seen as budget drama. National parks close, federal workers miss paychecks, the media debates party politics. But for the precious metals market, the bigger risk lies not in administrative operations, but in disrupted data and oversight. During a shutdown, COMEX inventory reports can be delayed. Updates from the CFTC can be postponed. Information flows about market positioning, deliveries, and system stress will no longer be transparent in real time. In other words, if a real delivery failure occurs, the market might not know it for weeks. And in finance, information darkness is always more dangerous than bad news. This is where a paradox emerges that confuses many people. Quite a few argue that a shutdown will cause gold and silver to fall because cash is king, just like in March 2020. But current data are telling a different story. In 2020, gold and silver were available. The problem was that no one had US dollars. Today, US dollars are not scarce, but physical metal is. You can print more money. You cannot print another silver bar. And this is why mechanically comparing today to 2020 can be misleading. When a crisis is about liquidity, central banks have tools to intervene. When a crisis is about physical inventories, monetary tools are almost useless in the short term. The story becomes even more striking when we look at a rarely mentioned metal, platinum. Platinum is not a speculative metal for retail investors. It is an industrial metal used in catalytic converters, medicine, and oil refining. When platinum lease rates jump into double digits, that is not about market psychology. It is because factories genuinely do not have the raw material to operate. This is an independent verification variable showing that the problem is not just in gold and silver, but in the metal supply chain more broadly. If a quietly industrial metal like platinum is flashing supply crisis signals, what does that imply for silver, a metal that is both industrial and monetary? From here, the story returns to the US dollar. A gold price approaching $5,000 per ounce is not just a nice round number for price charts. At that level, the market capitalization of all the gold above ground begins to approach the scale of the US M2 money supply. When a defensive asset reaches a size that competes with the global reserve currency itself, its psychological role changes. Gold is no longer just a hedge. It begins to be seen as a monetary counterweight. Not because someone declares it so, but because balance sheets start to reflect it. In a context where U.S. fiscal discipline is being questioned, the mere existence of such a price level is enough to make central banks and sovereign funds far more cautious about selling gold. And here, a very normal financial feedback loop forms, yet one that is systemically dangerous. High prices make holders unwilling to sell. The scarcer supply becomes, the easier it is for prices to be pushed higher. This is not a conspiracy theory. This is rational behavior under uncertainty. The twist of the entire story lies here. The precious metals derivative system does not need any conspiracy to become fragile. It only needs one foundational assumption to stop being true: the assumption that most contracts will never demand physical delivery. When that assumption wobbles, the entire structure starts revealing its weakness. And that is why the next 6 days are not really about Washington, and not only about COMEX. They are about a bigger question. In a world of high debt, strained fiscal policy, and monetary policy stretched to its limits, by what logic will markets reprice the US dollar, gold, and silver? Will derivatives markets still be trusted if physical delivery becomes the exception rather than the rule? What does paper price even mean if physical prices keep diverging further and further? These are open questions. There is no preset conclusion. No doomsday has been scheduled. But public data, historical precedent, and the behavior of the physical market are suggesting that we may be entering a phase where trust in familiar financial structures begins to be seriously tested. And if you've followed this far, I'd really like to hear your view. Do you think this is just a short-term technical squeeze, or an early sign of a deeper repricing of the US dollar, gold, and silver? Leave a comment and share this video with someone you think needs to see this story from a different angle. Because whichever scenario you believe in, one thing is certain: the precious metals market is saying far more than today's headlines reflect. And this is exactly why the next 6 days are not just a political milestone. It means the precious metals market is facing a real-world stress test. Whether paper contracts are still backed by real metal, or only by the belief that no one will demand delivery. The question posed at the beginning is now clearer. It is not how high gold or silver prices will go, but how this system will react when the physical world forces it to answer. In monetary history, every period of fiscal and monetary instability has been accompanied by a return of gold and silver as purchasing power hedges. Not because they are perfect, but because they exist outside the credit system. And this may only be the beginning of a phase in which that role once again becomes more central. The coming weeks will be crucial, not in years, but in days and in a few delivery cycles. And we will be closely watching every signal from inventories, lease rates, and physical market behavior. How do you think this will affect the US dollar, gold, and silver over the next year? This is Money Cycles, where we dig deep into the quiet movements shaping the financial system. To stay up to date with the latest developments, you know where to find us. Because when monetary history turns, it rarely does so loudly. It begins with very small details that most people overlook.